Do you wanna? Is it ready? Okay. So today I will present first, and then Judy can step up and share her portion. I'm going to share about the ABCs of title, right? Many of you that have been in real estate or brand new to real estate, this is a perfect class because a lot of times you work with your clients up until the contract, right? And then you submit the contract to the lender and then to us as a title company, and then pretty much just working with clients and just waiting for the closing. But what are all the behind the scenes, right? So that's what the class is today. Um, so from the contract, what do we do when we examine the title, provide the title commitment, until like the survey, how to read the survey, how to read the closing disclosure, right? And then come to closing and funding. That's a perfect day because that's when all of us get paid. So let's go ahead and start. Okay, so once you receive the contract, it should be accompanied by the earnest money and option fee, right? Now, before you submit the earnest money to us as a title company, and then the option fee goes to the seller. Well, the law has just changed recently, right? So now the earnest money and option fee will be lumped together and sent at one time to the title company instead. So just so you know, although we are holding the option fee, during the transaction, the seller can always request us to release the option fee to the sellers. Okay. Why do they do this? Is because it's easier for the buyer. Instead of making sure running to two different places, getting the earnest money to the title and then option fee to the seller, now everything is just one stop. Okay. Um, Once we get the contract, we will assign a GF number. GF is standing for guarantee fee, okay, guarantee file number. So then we're gonna send you a thank you email saying that thank you, we have received this contract, who'll be handling the process, who's the assistant, etc. And then what's the next step? Okay, we're gonna send an email to your buyer and CC the agent, letting them know here are the options to deliver earnest money and option fee. Okay, so what are some of the options? We can send them the FedEx label. They can overnight the check. They can deposit it remotely through Zocam app, okay, or they can wire. So right now is a perfect time every single year for wire frauds. So, we work with a lot of Asian ethnicities and the minorities communities. So sometimes we run into issues because they're not too tech savvy. But please keep in mind and please understand that the reason why our emails and especially our wire instructions, anything related to money and confidential information is secured. It's because of that. And a lot of time, and I'm going to share with you live experience today, right? So for example, your buyer may receive an email. And in the email, it would say like Cindy Vo with Providence title, everything just as if it's coming from me. Okay. It would say, hi, Judy, your closing is scheduled for tomorrow. Here is the one instruction to send us the money to the trust fund account. Okay. Well, the buyers doesn't know, right? So they're like, go ahead and send the money. And of course, that's fraud. That's scam. They lost the money. So what happened is on our emails, we always have that wire fraud language. And before we send the R1 instruction to anybody, it's going through what is called certified software. Okay. I always recommend buyer and seller. Seller can verify their wire instruction, and buyer will be receiving our wire instruction through that software. And why? So let's say that the seller may accidentally put in incorrect information or anything like that. Certify will issue up to $1 million insurance policy for the wires. Okay, but again, when buyers go through that secure link, it will ask them questions as if like you're running your credit report. What car have you owned before? Something like that. So it's very very secure. That way, there's no chance for them to lose their money. Okay. But again, back to the technical things, a lot of times they're having issues logging in or anything like that. And also, emails that we send out to you guys, especially with the attachment, is always secured. However, once you create your password, you don't have to keep putting your password in afterwards. Okay, so that's very secure. Um, so then once we send out the options to send the money, we got the money in, the deposit, we send the receipted earnest money out. Not sure how your experience with other title companies on the residential transaction, but for us, when we send a thank you email out, we also put in the body of the email the critical date list, right? That's very important. Although you read the contract and everything go through and it was signed, but we feel like it's so much easier just to read in the body of the email. Okay, well, the deadline to deposit earnest money is tomorrow or 2 days from now, right? Survey provided is with this day. Home warranty, closing date, financing critical. All that dates will be listed in the body of the email, so it's easier for you to keep track of it. Okay. Um, then it goes to the title examination, right? This is when our examiners will go through all the records, public records, they pull everything together, and then they create what is called the title commitment, okay? And I'm going to share with you what's on the title commitment. So title commitments has 4 schedules, A, B, C, D, right? On Schedule A is actual facts. Schedule B, buyer notifications. Schedule C, clear to close breakdown, and D is disclosure. Okay, so what does that mean? On Schedule A, the who, what, where, and how much that is involved in the closing. So it will list out all the applicable buyers, sellers, lender, and amount of the loan and sales price, includes the legal of the description. Just so you know, title companies only insure legal description and not the property address. Okay. So like I ran into a file yesterday, the buyer keeps saying, he even took a picture of the street sign. He said, it says avenue, but your file says street. And I keep having to explain it to him, sir, we only insure the legal description. So really it doesn't matter street or avenue to us, but we goes by the plat, right? So whenever they develop the land, they go to the city and they create the plat. On that plat, whatever it says on there, even if the city plats make an error, if it say street and the sign say avenue, we goes with street. Okay. Um, but that's what is on the Schedule A. It will shows who the current owners are. Does it match with the sellers that's on your contract, right? The legal description, is this the right property? Okay, who's the new buyers is? What is the insure amount for the owner's title policy and the lender's title policy? Do we know what title insurance is? Okay, let me go ahead and share that because it's very important. A lot of times when you put in the contracts, you will get that question asked, right? Why am I paying for this title policy? Okay, well, first of all, everything on the contract is negotiable. Okay, there's no such thing as set to stone of who's paying what. Everything is negotiable. So there are 2 types of title insurance. First is called the owner's title insurance. Well, as the wording is protecting the owners, right? Which owner? The new owners. So what it does is, let's say today we have a closing. What is today? The six. Okay. So today we do the closing. After today's closing and funding, we will issue the new buyers the policy. Is called the owner's title policy. Okay. What does it do? First of all, is helping the new owners anything against the previous owners. Okay, so let me explain this. When you drive a car, you have insurance, right? For yourself, you have life insurance. Everything has insurance. All those insurance, the premiums, you're paying continuously, right? Until you no longer need it. But for the owner's title insurance, it's a one-time fee. Okay, it's helping the owners from anything errors or previous sellers liens. for example. So again, back to the store. Let's say you close today. We did the whole title search, right? We go to closing. Everything is funded. Let's say next year, your buyers want to sell the property, right? Going through the same process. However, the previous owner's liens show up. Okay. So what happened if you don't have an owner's title policy? You are entitled to pay that lien off. Okay. Let me repeat it again. A lot of clients that I know, they usually want to save the money, save closing costs. So what they do is, especially within the families or friends, right? They just want to do a warranty deed to transfer over, or like for sale by owner. When you guys are not involved, they just want to do for sale by owner. They sell it to someone they know, right? They want to cut down the costs. They just want to do the warranty deed. So no title search, no title policy issued. So what happened later on? They're stuck with those liens, right? I want to share with you another story. This was very interesting, and the case dragged on for years. Okay, so we did a closing, and everything went well. You know, the seller to the buyer, and then after the closing for like a year later, I was reached out by an attorney saying that, well, my clients um, need to file a claim, and I was like, what claim? So it turns out the seller who sold the property to the buyer also sold the property to the tenant. Ah, so it was an investment property, right? There was a tenants in there. So he sold the property to the tenants before he sold the property to the real buyer. So when the new buyer, it was also going to become his investment property. So he came in and he tried to kick the tenants out because the tenant was like, I'm not paying any rents. So that's when it started, right? So they hired an attorney, and then the tenants hired an attorney. And I was like, okay, well, first of all, we didn't show her as the buyer. So I asked all these questions. Was a contract executed? Was a warranty deed recorded? And she gave me this handwritten, like 2 lines, contract between them. There's no warranty, nothing involved. And then she showed me some handwritten receipts, you know, like those receipts where you give a check to someone else and they just give you this tiny receipt you can buy at Staples. Shows that she already paid him $20,000.
So your client was the tenant or the investor?
My client was the buyer was the investor.
Investor. Yeah.
Yes.
Okay. Sorry. Fine. Yeah.
But if he found out that, you know, the tenant won't move out because she claimed that it was her home.
And the tenant had the tiny receipt.
Yeah, yeah. So that's what happened when you have owner's title policy. Imagine if you don't, then what? What happened? You lose the home, right? Or if there's liens from the previous sellers, you're stuck with it. So you just have to understand the importance of the owner's title policy, especially you as a realtors, right? Because again, the realtors represent the buyers and the sellers, but sometimes they may want to do shortcut, especially when there is a cash transaction. When there's a lender involved, you have to have insurance. But when it's a cash transaction, they have the choice.
Can I share a personal story?
Sure.
It's still going on, actually.
Yeah.
So I'm also an investor. I bought a piece of land, East Dallas, from a realtor. I mean, not from a realtor. There's a leasing agent, and then she is like I say, it's the land. So I bought cash with it, and so everything just worked out just like any other transaction. You know, there's title involved, there's earnest money, there's option, and all that. And after we closed, few months later, I was served with a lawsuit because what happened was that found out the seller that I thought the alleged seller that sold the property to me was not the actual seller. So the actual seller now is suing me and the listing agent and the title company for that land that the real seller is supposed to own that they didn't sell. So luckily that I had the title insurance, even though it was cash, but I had the title insurance for it. So that the title insurance company then sent me back my money. The problem that I say is still going on because the lawsuit is still there because the real seller thinking I'm somehow still involved. Why this with this fraudulent transactions?
Right.
So that's another thing is the fraudulent transactions that you have to, those are the things that you should tell your client why you need to have title insurance.
But why would the title company give you title policy?
Yeah,
they should search all the titles and figure out who's the owner.
Because what happened with my transaction was that yes, they verify the ID because with land you can probably explain this better. They don't need to go to the title company to do the closing. They can do they call it mail closing. So I guess you can explain that better than me.
There's a lot of different ways, for the transaction to be fraud. So the thing is, that's why whenever we feel suspicious about file, we always ask for more information. And it depends because, we also offer a free mobile closing, right? Free mobile notary closing, because just to make sure that the clients can sign, at their convenience. But our notaries are well trained and they're certified. So they will know what to verify, actual ID, signature, the face, the picture, everything on there, right? Some people will try to do the shortcut. So sometimes they are willing to notarize documents just by the copy of the ID. When you make copies, and I'm going to share this real stories happening in, I believe, in Dallas or Plano years ago. Same thing. The transaction went through and it was an investors. The buyers are flippers. So after the closing, they went to the property and they start making, remodeling the property. Well, they found corpse in the backyard. They brought the police over, and after the investigation, it turns out that the guy killed the actual owner, buried him in the backyard. Okay, went to the closing, told the escrow officer he forgot his driver license, and if he can just fax it over. So he faxed it over, they accept it, they close the transaction. You see? But you gotta know when you fax something, it's gonna be blurry. You can't tell if it's a real thing or not, right? That's why a lot of times they're like, well, Sydney, can you just close me? Like, my wife is not here, but I have her ID. No. I'm in this industry for way too long. I'm not doing that. So back to the question, there's many different ways that can be frauds, right? Sometimes, and again, this is why title search is very important, but we are human beings, right? We do make mistakes. Sometimes the property, and I'm running into a file right now that's why we have to double and triple check everything. The property lies in two different counties, Tarrant and Dallas. But then my examiner, well, not my examiner, it was another title company, examiner did the title search, but they only searched in one county and not both. So the commitments that they pulled over was like free and clear. There's no liens on there. Okay. Right before closing, they were informed by another attorney that it was about to foreclose tomorrow. So the whole thing went south, and the buyers freaked out. So they moved the transaction over to us. I was able to reach out to the attorney, the foreclosure attorney, because it's like actually it was supposed to happen yesterday. It was flipped over to us on Monday. So I reached out and I explained to them, we are handling this transaction. Is there any way you can pull it out? But things like that, things can be missed. Just because they missed searching another county, imagine how many things they can miss that were recorded for that county, right? So human errors, a lot of things can happen, fraudulence, intentional fraudulence, right? But again, things can happen, but that's why you need an owner's title policy. Because like her situation, if she doesn't have one, then she's screwed.
Yeah.
Big time. So, but again, keep in mind it's a one-time fee and it will stays with you forever until the vesting names change. Okay. So if you're gonna give it to your kids, that will not follow. Because now it's from your names to your kid's name. Okay. Another type of fraudulent could be like the heirs, right? Power of attorneys. Okay. All of that stuff. We have classes that talk about the legal issues and all that stuff. What are things that you can avoid having issues for closing? And that's something that we can explain later. Okay, but let's move on. The lender title policy, or we call the loan title policy, is protecting the lender. Okay, Judy, you're a lender, so you know. When do we need the loan policy? Common sense, whenever there's a lender involved. Okay, so the lender or loan title insurance will not be issued for cash transaction because there's no lender. So what does it do and why does lender needs it? It guarantees the lender to be in first lien position when it comes to foreclosure. Because remember, HOA can foreclose too, right? So if they have that lender title policy, if HOA wants to foreclose, they have to do one of the two things. First, they have to pay it off the lender, or second, they cannot foreclose without the lender's knowledge because the lender is secure as first lien position. That's what the lender title policy is. Okay. Again, it's a one-time fee, and the lender title insurance stays on there until they switch the loan or switch lender, right? So that's what it is. So it makes sure that the vested owners are the actual sellers, right? Because a lot of times you work with sellers, and they could be the heirs, right? So when we pull up title, it's not their names, right? It's going to be the deceased person's name. So then we have to go through and make sure what are some of the process that we have to clear to make sure it's legal, save time and cost and all that stuff. Okay.
Cindy, quick question on the lender's title policy.
Yes.
If it is a hot money lender, do they also get the same lender title policy, or
It depends on them, but a lot of private lenders or hard money lenders or even owners finance, they will want to get that lender policy. Because if anything happened, anybody wants to foreclose a property, their loans will be paid off. Otherwise, they're losing all the money.
yeah, okay.
Yes. So even sellers finance, I would suggest them to get a lender policy. Okay. So what's on Schedule B? Restrictions, building lines, covenants. So it will shows on there if the property has a 10 feet building line, 5 feet utility easements, right? All of these should be reflecting the plat also. Okay. If there's mineral lease, if it's recorded, it would be on Schedule B also. Okay. Keep in mind, title companies like us, we don't research minerals. No minerals. So, or like covered, not like the ordinance code, like the zoning and all that codes, right? So we don't research those. Those are not the duty of our title companies. So again, that's what Schedule B is for. So by looking at the Schedule B, you can tell if there's HOA, right? If for some reason the listing agent didn't disclose that, or if you didn't have any information, Schedule B or Schedule C depends on how title do things, but most of the time it'll be shown on Schedule Bs, and you can tell. Okay, Schedule C.
So,
Yeah.
one more question on the minerals. Minerals,
Mhm.
like what company or who do we typically go if, let's say, we're buying a big tract of land
Uh-huh.
and there's also like isn't there like a mineral endorsement that we can purchase so that like
No endorsements. Let me see if I can get your question right. Okay.
there's two parts. One is like, okay, who do we go to if we want to go research if there's any like
Minerals.
mineral lease out
Right.
there, because sometimes they are not recorded,
Mm-hmm.
title will not show,
Right.
right? So who do we go to do like all this research, whether there's like a unreported mineral lease?
If you feel like the land may have minerals, right, there's a separate individual company, private company that does the minerals, right? So they will go, you're going to have to hire them. They will go out there and they will do all the research about the land, whether they have potential minerals or not, right? Second is the sellers or the listing agents may know, right? Because the sellers would know unless they inherit the land or something like that, they won't know. But a lot of times they would know the information, right? So, and then when we do the warranty deed records, from the past warranty deeds or even preparing the new warranty deeds, there's on a portion right there, it would say reservation, right? If they want to reserve the mineral rights, if the previous sellers have that under the reservation, then more likely we know that there is an existing minerals or not. It depends. Because sometimes they just want to reserve the rights without having an active minerals.
Right.
Just in case, they were like, well, just in case I can sell the property, but I still want the mineral rights below it. But yes, there is a separate company that can do all of that for you.
Okay.
I think I know, like a lot of times the railroad commission or something, they do a lot of those, all of that stuff.
Yes, but
So
it's like a separate service, like inspection or appraisal company separately that you can request and pay, and then they will come out and do the research and come up with the report for you. I can guarantee you around here there's none. Tarrant County, a lot in Tarrant County.
Mansfield.
Yeah, Mansfield, Fort Worth. And if there's minerals, then it can also be transferable and you get money paid out of it too for certain years. And then after that, it goes to the city. Okay. If there's gold, then you don't have to report to anybody. Okay. Schedule C. This is very important. It's a basic roadmap to get to closing. So C stands for clear, right? We have to make sure everything on Schedule C is cleared. So what's on there? Deed of trust, liens, AJs, requirements. So let's say that husband and wife signed the deed of trust from the previous one for the current sellers, but only the husband on title. So we would add the requirement on there, getting the marital status for the seller and what happened to the spouse. And we always need the spouse signature. Okay. Bankruptcies, divorces, right? All of that stuff will be listed on Schedule C. If the seller is an investor, we also put the requirement on there that we need to review and approve all the entity docs. Okay, so that's Schedule C. Cannot close without clearing the Schedule C, unless sometimes they're willing to take exceptions. Okay, then we move the exception to Schedule B, because this is a title commitment. It's like a pre-title policy, but the actual title policies only have Schedule A and B. It will show us who the new owners are, and then any restrictions, covenants remaining on Schedule B. So anything that left on Schedule C that we're going to take exception, we have to move it to Schedule B, because that's all it is on the title policy. Okay. So searches, like I just say, who are the heirs, anything legal involved, all that stuff will be on Schedule C. Schedule D is just a disclosure. The total premiums with all the endorsements, who owns the agency. So like Providence Title, we are the agency. We're not underwriters. But it also listed on there who the actual underwriters is. Could be Fidelity or Stewart or any underwriters that we chose, right? You guys can also choose an underwriter too. So sometimes when I work with the commercial clients, they know, right? They're like, well, I want to make sure that my policy is with Fidelity. Okay, whatever. As long as they're one of our underwriters, we can just switch over. Okay, so that's on Schedule D. Okay, so why we do the title commitment and all that stuff, and there's a lender involved, we always send out the buyer and seller information form for them to fill out. So the buyer will need to fill out that form that will give us the information of the lender, right? So a lot of times the lender will send us the title request, You put on there the loan information, all that stuff. We send them the title work so they can process. And then they will request all of this stuff, right? So like the CD, tax cert, commitments, warrant instructions, closing protection letter, survey, chain of title, earnest money, and option money receipt. These are the normal items that we always send to the lender. Okay. Survey. And then for the survey, and we can go into more detail for the next class, where I will bring a professional surveyor come in and show you how to read the survey, how to understand both residential and commercial as well. Okay. But then we look at the survey, we're going to make sure everything on there is correct. We're going to make sure there's a seal, the company is still in business, right? Legal description match, and then we send it to everybody. One thing I do want to point out on the contract under the survey, right? There's option A, B, C. Okay. A lot of realtors misunderstanding option 1, which is the seller is supposed to provide both the existing survey and the T47, which is a survey affidavit. If they fail to provide those, it'd be the seller's cost. If the seller provide those and either lender or title company cannot use it, then you see the box right, buyer or seller. Okay, so you represent the sellers and that box was checked. And if your sellers cannot provide both, the buyers can order a new one, or we're going to have to order a new one for them at seller's cost. I get this argument a lot all the time. Okay, so I just want to point it out. So here's a survey. Again, why do we need a T47? T47 is a survey affidavit, and it only applies if the seller is providing an existing survey. Because on the survey affidavit, it will state on there if any changes to the survey from the property, right? So if I bought the house and next year I'm going to add a pool, but then at the time of the purchase, my survey didn't have the pool on there. So I can add on there, well, the pool was added in 2022, for example, right? So all those, again, are disclosures. They're very important. Even though it says on there, existing surveys can be used up to 10 years. For us, it depends. Because if it's older and there's no changes and there's nothing wrong with the survey, we're willing to accept it. Okay.
And if the company that has done the survey has closed down and the survey is only say 3 years old, then what happens?
We cannot accept it.
Then you order another survey.
We have to order a survey, and then we go back to the contract and say who's responsible for the payment.
Okay.
And then charge on that side.
Cindy, can I ask a question?
Yeah.
Full disclosure, it involves my house. It's on a corner of a subdivision.
Yeah.
And the subdivision focal feature is on the corner of my front yard.
Yeah.
I realized, I don't know, a month or two ago that my sprinklers are watering the focal feature as well as the strip along the sidewalk.
Mhm.
Does the survey of my property include that focal feature out to the other side of the sidewalk, bordering the street? Is that a typical thing?
The survey only shows your lot. It shows your lot, which is always the bolded lines, right? Rectangle, whatever shape your lot is, and then your house, and then any building lines, easements, all that on there. It doesn't show outside of your lot. Okay? So if your sprinkler
That might be an HOA question, huh?
Yes,
Okay.
yes. That is going to be an HOA question.
Okay.
Did you get noticed by HOA?
No, I was just doing a sprinkler check and
Uh-huh.
noticed that I'm watering the neighborhood sign with all their plants.
You're a good neighbor. They get around
If you haven't been notified by HOA, then you're fine.
Okay.
You may want to change your sprinkler back into your house versus.
Right, exactly.
But yes, we got to have the survey because we got to make sure that it's insurable. What if the fence is over the neighbor's lot or anything like that, right?
But a lot of times when you buy a cash purchase, sometimes we won't have a survey.
Right.
Sometimes title policy will not require you to have a So how do you ensure the property line and all that?
So again, we go everything by the contract, right? If it's an owner's title policy and they don't want the additional survey coverage, we don't even need to look at the survey.
So you just exclude the
Right.
survey coverage?
Yeah, it depends on the contract. So if the contract wants survey coverage, that's when we have to review the survey. And then if we approve it, then we can issue that endorsements, right? But if there's not one, then we don't even need to look at the survey. So after the closing, sometimes the buyers, cash buyer, we don't need survey, right? They will always come back and ask us, well, what if happens something, to this property? We're like, well, you bought it as cash and your contract didn't mention anything about the survey, so we don't need a survey. We didn't look at the survey, we didn't approve it. Okay. So yeah, it depends on the contract. For cash transaction, you can still, it was, if I remember correctly, it was section 6A8. So it would say will be deleted or will not be deleted. If it say will be deleted, then we do need a survey to review. If it say will not, then we don't need one on cash transaction. Okay. So then again, that's the portion. I went ahead of the slide. But this is the portion where it says right there. Okay. And it bolded right there too. So if the survey rejected, then who's paying for what? Right? If this box marked seller and the seller provide us a survey and the T47, and of course we can't approve it, and we ask the sellers to pay again, they will come back and try to argue with us and say, well, we were provided to you. But this box was checked. It says that if we can't approve it, you're gonna pay for another one. So if you represent the seller, you gotta make sure that everything is correct right there, right? And double check. Okay, the CDs.
Sorry, one question about the survey. Isn't that like a?
You have reached the max of questions. So I'm just kidding.
There's something like shortages of the area.
Uh-huh.
So that's the additional endorsement, right?
Yes.
For the shortage. So what does it really cover? Because if you guys already reviewed the survey, the boundary line, easement, and all that, then why do we still need to have additional endorsements for the shortages of the area?
Okay, so let's say that you give us the existing survey, right? And let's say the fence is encroaching the neighbor. Okay, if the fence is encroaching the neighbor, we can still approve the survey. We will add an exception to Schedule B, saying that we cover everything on the survey except the fence encroaching the neighbor. Okay, but if you get the additional survey coverage, and if we approve it, then that portion will be insured. Okay, so down the road, the fences are encroaching the neighbors, right? Depends on who they are. If they've been nice enough for the past years, but who knows, maybe the property was sold to another person and that person don't like you, right? They'll come back and say, well, Calvin, your fence is encroaching my lot, right? Then what happened? And could give you a problem and all that stuff. And that's why, because you have the survey coverage, you can go back to the title company and file the claim, and then we'll make sure if there's any court costs or anything like that, it will be insured under that transaction. So the additional survey coverage is very important, and it doesn't cost much.
Yeah.
Okay.
So the claim would pay for the court fees and all that, but how about if the neighbor said, hey, you need to relocate your fence back within your property line? So the homeowners, so what does the title company covers? Just the court fees?
Well, it depends on the fence too, right? If it's encroached over the neighbor, but depends on what kind of encroachment and how much effective it is going to be too. If it's something new, or if it's something's been there like for 2 decades, right? So there's different things, more details when it comes to like title policies, claims, and what's covered. There's always like what we call is the master indemnity. So on there, per transaction, it will list it out what are the things that it's actually going to cover if something happened, right? But again, it could be the same case, fence encroaching the neighbor, but it could be easily fixed, or it could turn into a nightmare, right? So it will give you all the coverages of that specific transaction.
So the expenses to fix that issue is going to be reimbursed by the claims, or I just want to know like what?
It can be, yes.
Oh, okay.
It can be. So if we insure it and if there's going to be an issue, then it's going to be covered under the policy.
Okay.
Yes. And it could be court costs, attorneys, the fix of the fence, anything like that. So whenever we see that extra endorsements, we always have to make sure and double check.
Mhm.
So, future issues arises.
But I think like the record office has the property line there, so it doesn't matter how your fence put, the property line always the same, right? So it's not like you build a fence here and then this property belong to you. So
Right, but yes. So let's say this is your property, right? The fence supposed to lies on the property lines, but especially for older homes, right? The previous seller may just do it by himself. He didn't want to pay a professional licensed fence guy, so he just put up the fence by himself. He didn't even look at the survey, so he just put up the fence, right? Where he put up the fence may not be the neighbor's current fence line, so they may not have issues, right? But who knows? Like I say, down the road, maybe the neighbor wants to do the fence, a new fence, and then they found out that your fence is over their fence line. That's when the issues can arise. Supposedly, everything has to be on the lines, but things can happen. Right? Okay, so closing disclosures. If you're in the business before 2015, you know that this closing disclosure never exists, right? It was a closing statement, or we call it a HUD, and then it goes to the 2010 HUD, and in 2015 is when the closing disclosure came out. The intention is for consumers to be protected, and also for them to read and understand all the fees better. However, that's not the case. So I'm going to share with you the closing disclosures, what's on there, and I'm going to show you how to read the closing disclosure. Okay. So basically, it was have to be disclosed 3 days before closing. Right? 3 days before closing. The consumer, the buyer, the borrower has to review everything and approved before the closing happened. Right? So the CD will go back and forth between title and the lender. We call it the balance CD, right? So they send us the instructions with our CD with all the fees. We're going to add all of our fees together. We're going to work together to make sure that everything is balanced. Cash to close, earnest money is credited, tax proration, all that stuff. Okay. So before I move to this slide, I'm going to show you what the closing disclosure look and how to read it. Let's see. Here it is. Can you see?
Mhm.
Okay. So this is the buyer's CD. Okay. Closing date and disbursement date. Disbursement date may or may not be the same as a closing date. It depends. Because if you have clients that are out of county or out of country or out of state, then they may close today, but it's not going to fund till tomorrow or the next day, right? So the disbursement date.
Excuse me, can you zoom out the page?
Zoom in.
Yeah.
Okay. Okay. So then it will have like the sales price. This is all the loan terms. Okay, so they can see their loan amount right there, the interest rate, the monthly payment. Okay. And then right here is the escrow, property taxes, homeowner insurance, right? How much is added? So if you add this and the principal and interest, and it comes out this is their monthly payment. And then of course this is a cash to close, right? Now if we go to the next page, section A and B are lender's cost. Okay, this is normally directly to the lender or broker, and then this is a third parties, like appraisal fee, credit report fees, attorney fees. That will goes under Section B of the closing disclosure. And then title costs will be Section C. Okay. Right here, insurance, interest, and then this part is the escrow reserves if they have any. Okay. Here's a problem that we get asked. It's a question that get asked a lot. So the contract says the seller is to pay for the owner's title policy, right? But this one is showing a charge on the buyer side. Then the buyer's like, why am I paying for it? Well, you don't, because you haven't even finished reading the closing disclosure, right? Okay. So it shows on there. And then there's another section right here. And it says optional, right? Here. So this is what I mean when the closing disclosure came out 2015. The intention is for the consumer to read and understand it easier. But then when it comes to that part, it's so confused, right? First of all, the buyer is asking, why am I paying for the title policy? And second, why is this two different portions or sections? And then third is, it says option. So I don't have to buy one. Okay, so let me explain it to you. If you add that portion and the top portion together, minus $100, that's the owner's title policy of the purchase price. Why? Because the lender title policy is always $100. Yes, sir. $100. Okay? And then, of course, with all the endorsements that the lender require. So, 562 plus 1688, that is like a 2250, right? Close enough. So if you go and look on page 3 of the CD, it doesn't show in the CD, but 2250, if the seller is to pay for the owner's title policy, the buyer will get a credit right here saying that seller's credit, owner's title policy adjustment for 2150, less $100. Okay? And then, of course, on page 3 of the CD, here's the total closing cost. This is the pay by seller in advance. So what happened is we're in December, right? Property taxes are already out. Property taxes don't come out until like October, November of that year. Because they are out, we are collected a full year from the seller. So the buyer is crediting the seller back from the time of closing to December 31st. It makes sense because you're responsible for the portion that you are the owners. Okay? And then that down here, minus the earnest money, minus the loan amount, minus the option fee, and there's a bunch of gift funds. Okay, this is the closing disclosure. Questions? Any questions? Closing disclosure.
What's the right now they have CDs? What's the harder CDs? Or some title company provide CD and some are hard. So what's the difference?
Good question. Okay, so as a title company, we don't determine whether to use a HUD or a CD, but it's up to the lender, right? All the traditional lenders will use closing disclosure or the CD. And then some lenders, like private lenders, hard money lenders, the non-traditional lenders would like to use the HUD because it's easier to read, right? Now, how do they determine, let's say, especially for the private lenders and hard money lenders, sometimes they will come back and ask us, which one should we use? Okay. Normally, a lender, if they do 5 transactions minimum a year or less, they use a HUD. If they use more than 5 transactions, if they lend more than 5 transactions a year, more likely they need to go through the TRID guideline and issue the closing disclosure. Cash transaction, no lender involved, so there's no CD. So it's a HUD. Commercial, HUD. Okay. The only time, so the CD is issued by the lender, not title company, for the borrowers. So, title companies only issue the seller CD. Okay. So I want to point this out because sometimes when you ask us, you as a realtors ask us to give you a copy of the CD and we can't, it's because by law, if the lender instruction said, do not send it out to any other parties besides the consumer, we cannot release it to you. Okay, we cannot release it to you. So it's per the lender's instruction. We can send it to the buyer and then they can send it to you and then you can help them go over the closing disclosure. But if it stays on there, then we cannot release it.
After closing, when we get, title company still have to give us the documents after closing.
The CD,
Yeah, the CDs.
not necessary.
The closing statement.
Yeah, closing statements, there's some CDs.
On the seller, yes. But the buyers, we cannot release it without their permission. Yes.
But HUD you can give.
Yes. On a HUD, there's no lender involved. We can always give it to you. But also keep in mind too, like from the very beginning of the transaction, we send the buyers and the sellers information sheet to fill out, right? Right behind it, there's also privacy. So privacy section. Surprisingly, sometimes I receive those back from the client say that they do not authorize to disclose anything to the agent. And if they put that on there, then we cannot disclose anything to you guys as well. So it depends on all the documentation. Okay. So yes, so that's a CD, and then let's go back this, and I should be able to wrap everything up quickly. Okay, so once the lender receive everything they need, once title clear everything on our end, we're gonna issue a clear to close. Then that's when title will reach out to you and then coordinate the closing for your clients, right? Again, one of our services is mobile notary, and we offer for free. So your clients can just let us know a time and location to close. We send that person over there. They don't have to worry about anything else, and then the notary will bring it back to us, and then we can fund. Okay. Do keep in mind that once we get the documents back, just because your client signed the docs doesn't mean that we can fund right away, right? Nowadays, I see a lot of lenders that they do what is called table funding. So as soon as title receives the wire and we confirm that all parties signed, we can fund right away. But some lenders are still requiring to have all the signed docs, send it over to them. They have to review it, give us funding authorization, and then that's when we can fund and disburse. Okay. And then, of course, closing time, once we get everything over to them, then we will send an email to all parties saying that the close is now funded and disbursed. And voila, that's when you get your commission check. Okay. So when you get your commission check, we can we goes by the CDA, right? If you want your check separately, it will show us on the CDA. And then we'll ask you, do you want to check overnight or if you want to wire to your account? And we send you the wire disbursement so you can fill out information. We'll verify with you, and then we send the wires out. Okay? And then that's it. Congratulations, your file's closed. Any questions?
So all your expenses is according to the government, right? So if you want to go with you, so what's the advantage? Do you have any the fees compared to the other title company?
So the title premiums, the title insurance premiums is the same across the state because the state promulgated rate. Owner's title policy premium goes by the sales price, right? So there's no adjustment on that one. And then outside of that is we call the escrow fee or the closing fee, right? Normally it's $450 to $500 on residential. Our fees is $450. But keep in mind, we do offer the mobile notary for free, and that we pay out of our pocket, and that's normally $150 or so, right? Besides, the fees, it's just the services. It's just the services and the trust. If you trust that title company, there's always there when you need something. That's something that we provided for realtors, not just to handle the closing, but we also add values like classes. And if you need something night and weekend and I don't sleep, but I do. But yeah, it's just the services and the trust.
So you have a car?
Yes, ma'am. Yeah, I have it right here. I'll pass it on to you. Okay. Any questions before we bring Judy up? Okay. Well, thank you so much.
Thank you.
Can I borrow the clicker? Can I borrow the clicker? Oh, right here.
But you gotta-
Can I ask you one more question?
Yes.
So as a realtor, what do we need to do once we receive all the title documents? A lot of times we receive, I mean, are we responsible to review them and, catch anything? Cause sometimes a title company just put out exclude here and there. I don't know what the significance of all those papers.
Yeah, that's why if you know how to read the title commitments, right? When we send the title commitment out, you can get with your clients and say, well, okay, Schedule A is clear, and there shows that there's a previous lien on there. There's a building line restrictions to the property, things like that, right? But a lot of times when we send title work out, you gotta insert this. When we send title work out, we also put in the body of the email for you. So we would put like vesting, no issues. Survey approved. One lien needs to be paid up at closing, for example. Yeah.
So if there's some issue, then we can just terminate the contract, right?
Yes.
So what happened to
What's that for?
the earnest
Yeah.
money?
Oh, I thought that's.
Depends on the contract,
Oh,
right?
no.
So
Yeah.
on the contract, there's a section about the title commitment. Okay.
This is yours?
Title's supposed to be delivered within 10 days, for example, or 20 days, right? And then the buyer has certain days to review and reject it. And then seller has many days to cure the objection, right? They have to fix it. And then buyer has additional number of days to respond or terminate the contract. So if the contract was terminated because of the title issues or survey issues or HOA issues, everything is on the contract, right? As long as it's canceled or terminated within those period of time, then the buyer can get the earnest money back.
That is section 6.
Yes, but keep in mind, before is not an obligation. That title, everyone has to sign a release of earnest money form. But now it is an obligation. It is on the new contract. That title company cannot release it without the signatures from both parties, whether the contract was terminated within the option period or not. Okay, because there's too many claims going on. So
Right, so if some party doesn't want to sign the release or earnest money, then those money will be there, it doesn't matter how bad of the title policy or whatever, whose fault. And then a certain party cannot get the money.
Well, yes, and so the next step is go with the demand section, right? There's a demand section where you can demand the earnest money for 15 days. And then after that, you cannot work out with the other party, then we can only hold for so long, then we have to send it to the state, Austin.
So
But there's nothing that, we can do about that if the other party refuses to sign. However, if the seller refuses to sign, they cannot close another deal unless they release that earnest money. Yep. So if they want to sell it to another buyer, they have to release it out.
But the buyer cannot do anything. The buyer, you cannot hold anything accountable for the buyers. If the buyer's fault, then, if you don't want to release earnest money, then you have no way
If they miss the
to.
deadline, then it is buyer fault.
Mm-hmm. Yeah.
Then he lose the.
If you miss you miss a deadline for any.
Yeah, the buyer, if
Sectional.
they don't sign that document, then, the seller will not get that money either.
Right, but they can also enforce, the law or whatever, or get the attorney involved. take it to court. But
Which
sometimes,
costs more than the earnest money.
right, exactly. So that's why I tell them, look, if you're going to be taken to court over $500, is it worth it? Then you guys just need to work something out in between and just release it, you know? Go ahead, Judy.
So today I want to talk about temporary interest rate buy down. So because the interest rate has skyrocketed in the past few months, and it deterred a lot of buyers. They say, well, interest rate is too high, I'm gonna wait. So there's a remedy for that. So the last time I had when I had this class, I asked a realtor, so what do you tell your buyer when they say, oh, interest rate is too high? Then she said, well, we, this is, you all know that Dallas Fort Worth, that there's so many companies that moving, and yes, the market is soft right now, but still, it's, and when the interest rate goes down, then so many people is going to be buying, and your price is going to go up. I say yes. So that's the first part, what you're going to tell your buyers. But the second part is that help them with the temporary buy down so that they feel like, okay, yes, I understand, I want to buy, and I understand the price is gonna go up if I interest rate go down. I want to buy now, but I don't know if I want to pay this much right now. So this is what this program comes out of. What is the temporary interest rate buy down? So what it is it's an option for the buyer to reduce the interest rate and temporarily and in term. So for the monthly payment for a short period of time, and basically is to avoid the payment shock. So there are different programs that different year. There's a 2-1 buy down, there's 1-0 buy down, there's a 3-2-1 buy down, and we'll discuss that a little bit. And so basically, so give them that flexibility. Say, the first, say if we do the 2-1 buy down, we still qualify them based on your original, say 7% interest rate. But what happened is that it takes them the first year, it will be 2% interest rate lower that they are paying. What it is that money is going to be, which we'll do a Excel spreadsheet and it will show you a little better. So that the bulk of the money, say 2 years, the difference, it will go to an escrow account. And the escrow account from the lender, and every month that you pay, the buyer will be paying lower interest rate, lower interest, so that your monthly payment will be lower, but that the lender is still gonna have to get paid. So then that's when they every month that they take out from that escrow that amount to make up the difference. So basically it's easier for the buyer, say that they're renting right now and then renting to buying, that with the higher interest rate they feel like, okay, $500 increase in their monthly payment, then that's a shock. So say that they can maybe increase, using this they will increase maybe 200 from their regular rent amount, and then for the first year, and then they may get a promotion, or they may have the car paying off and things like nature in the next year or two. And so then this will definitely help. So those are the things that as a realtor you kind of want to understand your buyer as well. It's okay to talk to them about their financing, get to know them, oh, what kind of car you driving, when, so, oh yeah, I'm driving this and I'm about to pay off next year or so. And then that's when your mind's going to switch. Hey, why don't we put you in this program that, then that will help you ease up to, so your monthly payment, so you not have a big shock about it. So who is paying for this by the difference in buy down? So we have two different way of paying, but most of the time, most popular one is the seller, what we call the seller concession. So basically in the contract that we have, where seller concession is up to a certain amount, and that will come out from the seller at closing. And we can also do a buyer can have pay a portion of it. Like I said, this is not common. What happened with if you do seller concession, say is a 2-year buy down. And say for some reason they get transferred and they need to sell the house within a year and a half, but they have that half a year, 6 months of that interest rate, that interest that's in the lender's escrow. What happened to that when they sell? So what if the seller concession that's contributed from the beginning, that portion of it will add back, would be deducted from the unpaid balance. So add back to the seller. But if it's the buyer paying portion of it, basically that money is gone. You can't get that back. So it's easier to go if you can on your contract negotiate with the seller where seller will pay for the buy down cost. And most important is that cost, it will have to be exact or more than the buy down cost. Say the buy down cost is $9,800. You don't want to go $9,500 on the concession. You want to go $10,000 or $900, $8,000, whatever the exact amount. Which you can always. I will show you the calculation, but it's always talk to the loan officer. Make sure that what's the exact amount. And how do we do that? So, like I said, buyer usually qualify for qualify for the higher interest rate, basically, which is your normal interest rate. And here's the type of we have. 2-1 buy down is first year will be 2% lower than the note rate. Like I said, 7%. That's what your client qualify for. The first year will be 5% interest rate. So when you talk about 5% nowadays, and people will be like, "Oh, I'm paying 5% interest rate," then that's when they feel like, okay, I feel like I can buy a house now. And year 2 will be 1% lower, so which will be 6%. And then the year 3 will be a full note, which is a 7%. And if it's 1-0, so basically the first year will be 6%, and the second year will go back to your full note rate. So there's a different cost to it. So it depends on how you negotiate with the seller and how much the payment that the buyer is comfortable with. And so as on purchase only, it doesn't work on refi. So, or cash out refi. So on purchase, we can do conventional on the primary and second home. We cannot do on investment. And on FHA and VA, of course, it's just primary only. And we also do jumbo and bank statement. And the next one, how much can they contribute up to? That's also, there's a limit. That's why we're not introduced. There's a 3-2-1 buy down, which is the first year can be 3% off, second year 2% off, the third year 1% off. The problem with that is a huge amount, and a lot of time depends on the purchase your loan amount. You could be over the allowable interest party contribution, especially if the realtor. That sometimes realtors say that, hey, it's my relative, so someone I know, or he's doing another transaction with me. I am giving him a 1% rebate back. So when you add that 1% rebate in the buy down, that's, you have to make sure that that concession, that total amount, is not over the limit when we're talking about conventional and FHA and VA. So on conventional, less than 10% down is 3% maximum, and 10 to 25% is 6% maximum, and more than 25% down payment can be 9% maximum. And on FHA, again, this principal residence only can go up to 6%, and VA is 4%. So those are. You have a question?
Oh yeah.
Mhm.
Just about that part where it says less than 10% down.
Mhm.
So you're saying if the buyer puts 10% down
Mhm.
on their home, then they can possibly decrease their interest rate by 3%?
No, this is the maximum interest party contribution is what we call the seller concession. This between seller concession and the realtor concession, or if you have other concession that comes in on the closing disclosure, total can be 3%, maximum 3% of the loan amount.
I think I'm not familiar with the concession.
So like there's say 1% realtor contribution. Say you have a loan is 200,000, 1% is 2,000, and so total 3% is on the 200,000 loan. Total is 6,000, right? So if the realtor is already contributing 2,000, your seller concession can only go up to 4,000. So if you try to do the 3-2-1 buy down, and that would not, you can't work because it's over the limit of the 3% of the 6,000.
How often are realtors contributing right now?
I haven't seen much on this. It's personal reason, but I know what you meant. That nowadays, that because that lawsuit, that some are. So this is, that's why I have this up, just in case that more and more it's gonna come out. Then you want. So again, talk to your loan officer if you're not sure what it is, and always talk to the loan officer when you write a contract. That's why it's important when you have that relationship. So you can call if you trying to run an offer at 9:00 at night. You want to make sure, hey, am I just double check what's my number? You don't want to write on the contract, agree, execute it, and then found out that you over the limit. So
Okay, so just a question. So you said 3% maximum, it's 10% down,
Yes.
less than 10%.
yes,
So again, so it's 100,000 house, 3,000 is the maximum
it's maximum.
amount.
Yes.
Say a realtor is contributing that 3%, 3,000. If he is giving that as a concession, then in that case, seller cannot pay
No,
anything.
the seller cannot.
And if seller is paying something, then the realtor cannot pay anything.
Correct.
The total
If it's a
has to be-
conventional loan, yes.
Okay, so that percentage is the total of
Total.
the seller and any other concession
Yes, altogether.
altogether.
Mm-hmm.
So this includes any repair, amendment, concession also seller is going
No,
to
that's different. That's a credit.
Okay, that's a credit.
Yeah, that's a credit of the purchase amount.
So where, like in a contract, when an agent is writing this up and let's say seller agrees to pay towards this buy down,
Mhm.
where would you put that on the contract?
On the I think it's section 6, right, Joe? Am I correct? I think there's a section where it says
Settlement expenses.
the expense seller contributing up to
Okay.
certain amount.
12A1.
Oh, okay, there you go.
I think it's 12A1 because I just did it.
Yeah, 12A1.
Yeah.
Okay, so on that
Seller
box,
concession,
and that's where
So you can specify the amount.
you can specify. Yes,
The amount.
yes, the amount. Yes.
So, with that being said, because since they did the contract changes where it says, because now it's getting a little bit into like the repair. Some companies, some people don't want to do repairs because it's requiring licensing and all this stuff and provide receipts. So a lot of sellers are like, no, I'd rather just give you money. But if we're doing this and they're not wanting to do any repairs and they're going to give us money, then we're going to have to just max it out at that and then just take the L on the rest of it, or can we work around that?
You can either do credit or you can do the concession. Either way, you can do the amendment and then change that on the amendment number 2, I believe, where you can change out the purchase amount.
Okay, so we would just.
But when you change out that purchase amount, then got to make sure
That's
that
gonna
this is
change as
within.
well,
Yes,
right?
yes,
Okay,
yes,
so-
yes.
Okay.
And so we call this class is win-win-win. And why is a win? So win is that give seller more option because their houses is sitting on the market for so long, 45, 60, even more days, and then just a lot of times I see on MLS, on the remark, listing agent will put, hey, the seller is willing to put pay for buyer buy down concession and things like that. So those are the type of thing that it's a thing now. So you can put that to entice the buyer's agent to show, and a win for the agent because you make sure you get the deals and get it closed, and then then why I have this class today is because the interest rate, higher interest rate, and that's why we have this program. This program it's not new. It just it wasn't popular. It's that we didn't need it. So it was, it started a long time ago that we had this, and then now it come out again. And then like I said, just a lot of negotiation. You just need to know how to negotiate. This is just a tool for you. So, and that's what I have for now for the presentation, but I can show you how on this Excel spreadsheet that what the cost can be and how we calculate that cost. And that would be okay. So this is where I have to change the setting, right?
What are you trying to say?
Because it's on my computer but not showing there. So I think that's what I had to do last time.
So, Judy, I have a slight related to loan, but a slightly different option.
Mhm.
I wanted to talk and get your inputs on. Like sometimes the seller may have a
Hey, Joel.
loan which the
Yeah,
new
PC
buyer
person.
can assume.
Mhm.
So, in what scenarios can they assume a loan? Are there any? Because let's say if they have bought the house like 2 years or 3 years ago, the interest rates were much
How do you
lower.
do it? Mirror-
If the
mirroring.
new buyer wants to assume that loan,
Mhm.
which is at a much lower rate, do all lenders provide it, or is it only the FHA loans, VA loans? Can you?
This is on purchase only, on the new purchase only. So it can be on conventional loan, can be on FHA loan and VA loans.
No, I'm not talking about this one specifically. I'm talking slightly related but different topic.
Oh, okay,
So
okay.
I'm asking about, let's say that I have a buyer
Yeah.
and the seller has a loan on the property. So
Yeah.
they bought the house 2 or 3 years ago where the interest rates were low.
Okay, yeah.
Can the new buyer assume that loan?
Yes and no. You have, first of all, you have to the seller has to check with the original note, check with the original servicer and the lender, mortgage company, say if it's in the clause that they can't, assume to someone else. And if that happens, and then the lender, then the new buyer will work directly with the mortgage company,
I see.
the original mortgage company, because they hold the loan.
It's over there.
Yeah, but they still have to qualify.
Acting as a-
Yeah, they still-
They still have to qualify.
I know.
It's not like automatically assumed. The new buyer still have to qualify, but they work directly with the.
Is there a lot of receivable loans out there?
There are more.
I
Yeah.
mean, back then, like a couple of years ago, people.
Probably
a lot of-
no.
Here now.
Yeah, nowadays yes.
So which one's
But the
this
thing
one?
is that all the payment has to be up to date. You cannot have a default or anything.
The 2-3 years ago when they borrowed the money, a lot of the loan had assumable loan.
Yes.
Really? So we can.
Oh,
check
you
out-
mean a lot of? There are a few. Yes, I've seen people. Yes,
The
depends on.
conventional, most conventional.
Conventional,
assumable
most
loan?
conventional,
Oh,
you're not.
So that's what I'm saying. Depends on the mortgage company.
So we have to check with
Mhm.
verify with the mortgage company.
Yes, you have to verify with the mortgage company.
If but one of the things you guys have to understand on that is that if the loan, the assumable loan, for instance, is 400,000 that's left on it, and the market price of that house is 600,000, your buyer has to come to the table with $200,000 cash.
Yes.
So
People
the
are
property
not-
has
they're missing
appreciated.
that.
Yeah, if it's already appreciated and the seller has already paid some portion of that loan, now the new buyer has to come up with all that difference.
Yes,
Yes.
so it's more than 3% or possibly 10% on a standard loan.
Yes. So basically, you only have a note on whatever the balance is, and then the balance you just
Okay,
have to.
so if the loan is an assumable loan, is it a different way of writing it down, or is it any loan can be assumable?
Just have to check with the mortgage company.
Not any loan is.
Yeah.
Okay.
Especially VA. I don't know.
So I
VA
think
is.
if
VA
it
is
is
assumable.
if it is
Yeah.
assumable, then at the time of marketing the property, the seller will always say, hey, I have a loan which is assumable. Please
Yeah.
come.
Right.
So he will declare it because that is asset for his property.
Right. But again, if it's assumable, the difference, if they already have, a lot of equity, then you have to find a buyer who
But
has.
most people don't know if they assume or not.
Yeah, most people
No,
don't.
usually seller themselves know because
They have
know
to go
that
check.
This is an extra
Yeah.
incentive.
They have to
they
check
can
with
always-
the mortgage company.
Yes, that's definitely. So, let me have a chair so I can. Sorry.
To the assumable loans. First of all, it's very risky because here's why. You have to get approval from the lender, the current lender, okay? And they have to send you the approval in writing that they'll allow the assumption, okay? Otherwise, they can foreclose the property. So I've run into this a lot. The buyer's assuming the loan from the seller, right? And they didn't want to go through the lender approval because they're like, well, what if the lender doesn't approve? Well, there you go, right? So there's two ways. One is the buyer make the payment to the seller, and then the seller pay to the lender.
Wraparounds.
The lender can audit the file, right? And come back and say, well, Vinay, you're the borrower, but why is the checks coming from Cindy? That's one thing. So once they find out, they foreclose the property, right? And then second thing is you can make the payment directly to the lender, but again, the same thing. Why, like, if you make the payment to the seller, what if the seller doesn't pay the mortgage? Right? You're stuck.
That's just like seller financing,
Right.
the risk.
So a lot of sellers don't understand. They either do through the assumption or seller's finance, but they keep telling me, okay, well, Cindy, I want to do the seller's finance. And my question is, are you paying off the existing loan? Oh, no. Well, then that now it's become the assumption.
Right.
So you can only do the seller's finance for the difference of the equity, right? So let's say that we mentioned about $600,000 property, the loan is $400,000. If the sellers want to do seller's finance, he can only finance for the $200,000.
And on the second lien.
Right. So because the primary lien has to be paid off. Otherwise, it's assumption, right? We don't do assumption because there's other attorneys out there that can prepare all the assumption deed and the note and deed of trust and all that, but it's too risky. Because why? With the assumption, by the way, you cannot get an owner's title policy for assumption, right? Because we cannot issue a policy for the buyer when there's an existing lien. So imagine if your buyer willing to take the risk to do the assumption, you have to point it out for them that you will not get an owner's title policy.
Yeah, but in commercial, we do a lot of wraparounds.
Yeah, commercial.
The people are brave. We tell them the risk, but we do it.
Yeah.
And there are attorneys who specialize in this.
Yeah. Well, it's up to the clients, right? If they're willing to take the risk, then it's not your fault. But just want to give them the information that how risky it can be.
Yeah,
And
the buyer should be very strong that because it's not a death sentence, it's not a crime. The only thing is the loan note will become due. So they should have enough resources to take care in case of it becomes due.
Right.
Within 2-3 months, they are able to bring that much amount, then they are okay.
The difference between residential and commercial in my mind is that most commercial clients have experience.
Yeah.
Many residential clients don't.
Yeah, no.
They don't necessarily have business sense and they don't have real estate experience. So
Sure.
they don't necessarily know that their loan is assumable or not. They don't read most of what we send them.
True. You have to babysit them and hand holding.
Yeah.
And
They don't read the home inspection.
unless the buyer, because like before any lender forecloses a property, they always send out notification, right? So what I would tell the clients is, if you're willing to take the risk, make sure you have an extra $400,000 somewhere. So if the lender called the notes, you have it to pay it off before they foreclose, right?
Right.
Yeah, we do it in the commercial and we make sure that buyer knows that if something happens, they can take care, they can pay off the loan in 1 month.
Sorry for the
Oh,
diversion.
No. One thing that came to mind is that, it's nothing to do with buy down or anything, just something that, I get asked a few times. I will ask, are you buying this primary or investment? Oh, well, I don't know, which one interest rate is lower. No, you have to know, because the reason is that and as a realtor, I hope that you make sure of this too, that you want to ask that question. Are you buying a house? Oh, I'm living in a house right now. What are you going to do with your current house? Or, well, I don't know. You want to know what their plan is. And the reason is that we don't want to do a loan when it's supposed to be investment. They know they're going to rent it out. But because they want to get a lower interest rate,
Right.
they say, oh, I'm
Primary.
buying for myself.
That's fraud.
Because,
Yeah.
and also want to make sure that they actually resign, live in that house within 60 days of closing. Because a lot of times now, the lenders now, they don't have many loans. They start door knocking. It happens.
Really?
Yes. They start door knocking, and then if the person doesn't live there within 60 days, or they rent it out as a renter or something, and it's applying the cold notes.
Yeah, that's a question I get asked a lot
Yes.
at the closing table. So I'm buying this as a primary, but can I rent it out later? It's like, well, you signed this, so I'm not going to answer the question for you,
Yeah.
but you signed as a primary. And so that's why in the closing package, there's a lot of repeated documents stating this is your primary home, right?
But they have to stay in for at least for 1 year?
2.
No,
In the primary residence?
a year, I think.
A year?
1 year.
A
1
year.
year.
1 year.
A year, 1 year. Yeah, at least 1 year.
What if you just leave it vacant? That would be okay? Or
No, you have to resign within 60 days. You have to leave there in 60
Just to
days.
show the electric bill.
Yeah.
Yeah.
Water bill.
All right. Well, we're married, but our home right now is only my husband's on title, and I'm buying this, but I'm going to be on title. We both can claim homestead, right? I know that doesn't work. It's community law, So.
Right. So want to continue the buy down. So we can do okay. So I'm just gonna do a example. So say purchase price $725, and then we put 20% down. So our loan amount is $580, and the interest rate 7.375. It's a 30-year loan. So let's do a 7%. It's easier to talk about. So see, I changed the 7% in the first year. Now it's 5%, and the payment originally is going to be. You know what? This is not right. Sorry, this is not the right formula. Sorry. Okay. So let me make it bigger. Okay. So say we have the loan right now is 300,000 and 80. The rate, obviously, right now we want to say 7%. And the first year is a 5%. The original note rate is 1,862. Then that's what we qualify them for 7%. So the second year will be 6%. So after the buy down from 1,800, we're talking about principal interest only. We're not adding property tax or insurance. The buy down payment is the first year is 1,503, and your monthly savings 359. And the second year, you can see the savings 184. So every month you have this saving, and then 12 months, and then first savings means for the buyer. but it's a cost to the seller if we paying by the seller. So basic total for 2 months is 6,526. So you can see it's 2.175% off the purchase price. So when you say you want to contribute the realtor 1%, then you'll be over that amount. So that's why, it's important to know what percent that how much the total amount. And this amount here said that if there's no other concession, and this is the total amount that you want to at least 65, 26, 30, 22, or 6,600 or 7,000 on that 12A box. And so that will be coming out from the seller, contributing to the closing cost for this. You have
Just math-wise,
Uh-huh.
On year 2,
Yes.
it's only 1%, but the buy down payment
Mhm.
is more than
Yes.
the 2% payment.
Yes, because you're 6% instead of 5%.
But it's only 1% difference.
1% difference.
So
from
why
the
is 1%
7%.
difference more than 2% difference?
This is a buy down payment. This is the monthly principal interest.
But that's how much the person's gonna pay.
Yes, the buyer is going to pay on
Right,
principal interest for the second
Got it.
year. Mhm. So so this will be the amount that you'll be, putting on the concession amount. Yes.
So in your example, like the 2.175, and then the buyer is asking realtor to give 1% cash back.
Mhm.
This buy down cannot be changed to like it's 2.1. It can't be 2.1.5.
No.
These are rigid. 2.1 is a rigid.
Yes.
Okay.
It can be 2.1 or it can be 1.0.
1.0. Okay.
So you see 1.0 here. If we do just 1 year, it would be $2,000.
Okay.
So you can choose that option
Got
too.
it.
So, and that's it's a simple calculator, but there's a lot of formula in it. So you saw how earlier that something happened. So, previous class, someone asked me if I can give it out. I would, but the thing is that I don't want to be responsible for if something formula goes wrong. So it's always, best to talk to your loan officer, like I said, before you put in an offer. So yes, go ahead.
So, okay, based on this example,
Uh-huh.
so like the process of this, so basically, they put down a lump sum up front. Would that be like when they purchase the house? And then, so, okay, buy down payment, so like, what's the, what?
So, like I said, this is just principal interest based on 7%. That's what they qualify for. If they didn't use this program, their principal interest will be $1,862.85. But this is based on 7%, whatever rate they log in with.
And okay, when they like put down their lump sum, is that just like it's a one-time thing, or
It's a one-time thing.
Okay.
Yeah, it's a one-time thing. So this amount or whatever amount you put in, this amount, say you put 7,000, right? The 7,000 minus 6,526.22, that would be on actually just the closing cost, regular closing cost that the seller contributing. But this 6,526.22, you will be in the lender's escrow. And every month that the buyer is paying this, the lender will pay this every month. They will come out every month like that. For the first 12 months, and the second year then the lender will then every month come out until depleting this whole amount.
So you're able to negotiate with the seller to help contribute to this rate buy down?
Correct.
Okay.
Correct. And that's why it's important for nowadays the realtors to know both sides. Otherwise, if you want to negotiate and the listing agent was like, what is this? It'll be hard. And especially also not just for the buyer agent, for the listing agent as well. You want to have this conversation ahead of time with your client. Say, hey, this is what's happening right now in the market, that you may have a buyer coming to ask you this. And when you price that house, you want to make sure that you have already talk about how maybe they want to already raise the price a little bit, or I don't know if that will support it, if the market support it. You want to calculate this amount in it. Yes.
Can we change the numbers and run a scenario? Because I have a listing right around that price. So it's actually 315.
Okay. What's the loan? How much are they putting down?
I don't know. You guys want to go with FHA or conventional?
Let's go with
gonna
FHA.
assume-
20% down.
Just do the 3%, just to give the worst case scenario.
Okay. So that's a 3% down.
So the reason I brought this up because we're talking about your sellers giving a concession and whatnot, and it's funny because the way the market is right now, some sellers are already giving concessions. Like for my clients, they're already comfortable with giving around 5,000. So from the 5,000 to the 7,100, it's all about $2,100 more dollars. So it could be where like, hey, we're almost at 80 days on the market, and then somebody brings me an offer that's still within the price range. I'm pretty sure if you just tell my clients, like, hey, we're already giving 5, let's go ahead and try to close the deal and go ahead and throw in another 2,100, make it 7,200 even, and we can work both sides. My clients get to move the house hopefully before the 100-day mark, and then the buyers get to go with a lower interest rate and help them out. So it's just about when you have the conversations with your sellers from the get-go, then this makes it so much easier when you present this to them. It's like, hey, we're already here anyways. We're already at 5 Gs that we're going to do a seller concession. Let's go ahead and throw in another 2,000 or 2,200, and we'll call it a day, move on, and everybody wins in that situation. But it's just about having that conversation from the get-go.
Yes, you definitely want to set the expectation, right?
So what is the difference between variable rate and fixed rate right now?
Right now, we doing as far as residential, still most popular is 30-year fixed, and we do some. You can watch out for ARM. Right now, ARMS is coming out, but nowadays still there's not much difference.
I saw the variable rate normally better than the fixed.
Usually,
For first
but
couple
for
years.
before a certain market, yes, certain times in the past, yes, the variable rate, the ARM rate, that it is better, but nowadays it really not much difference. But it is slowly coming because it's a different product, and then so it just depends on the market really. But right now, still 30-year fixed is still more popular, and the rate is better, and then also on FHA, rate tend to be a little lower than the conventional. The problem is that you want to try both, right? If the buyer have challenging credit or a little bit less down payment, you do want to try FHA and conventional. The thing is that with FHA, there's an upfront finance fee, and that also add additional expenses. So it all depends on the circumstances. So.
Is there a difference in interest rate between the traditional loan and the non-QM?
QM right now, we do investment DSCR, we do bank statement, those type of rate right now. If it's a good credit, you have some kind of experience, it's at 8%, high 8 or 8.75. But with regular conventional, somewhere about 6.75 right now. So, but with a conventional investment, that we're at 7.5. So
it's about a point different, right?
Yeah, it's just a point.
But I see a lot of people go with non-QM nowadays because it's less. They have to. They don't have to provide that much documents.
Right.
I it's better. Last time I heard the non-verified income is better. Actual loan is better than traditional.
So I mean, those if it's investor, with DSCR is very popular. That's what we do right now. Yeah.
Less documents, right?
Yes, less document.
Or like a no doc.
Yeah, no, we don't verify income. We just basically is the rental. We do an appraisal on the rental amount income, and then if that will at least higher or same as the mortgage, the PITA, what we call
1.25.
It can be lower. We can do lower as well. We can do higher either way. But of course, if the mortgage is higher than the rental, then it's gonna be more interest. It's gonna add some points to it. But what we call PITA is principal, interest, property tax, insurance, and HOA. Don't forget HOA also needs to be included. in the payment.
Otherwise, you have to put more down. Right?
Yes. So yeah, that's it.
All right.
Thank you.
All right.
Thank you.
Are you hungry?
5 minutes.
I think
We're gonna go to JS Chen across the street, right? Is that the goal?
Sure.
Yeah. So we'll do a family style. Anyone that's welcome to come with us. My name is Daniel A. If you haven't met me yet, I'm one of the team leaders here. Want to kind of show the platform really quick. I'm not going to go through the whole explanation, but just trying to idea of what EXP is about and how it started. And I have to go back to their technology of just being a disruptor, meaning having a platform for support. So for me as a broker, for expansion and things like that, how do I have other brokers work for me? Meaning there's a whole platform that supports us. So I want to kind of show you that and then just get a glimpse of it. So we have a little video game called EXP World. We're the first corporate company to operate in what we call the metaverse. So basically, give me 1 second. Where's my sound coming here?
Daniel, do you have preferred vendor opportunities within this model?
There's also opportunities, yeah. In give me 1 second. There you go. Yeah, so there are preferred vendors. We do. I don't know if there's an inspection company, but we are all 50 states. We're one corporate company, not a franchise. So what's nice is anyone has the opportunity to grow if they wanted to. But I want to kind of show you, just what this is, and I'll come in and say hi to Sheila. Hi, Sheila. How are you today?
Good. How are you doing?
Good. I have some guests. You're on the big screen. What help can agents or brokers or teams get support in the Texas broker room?
So they can talk to a broker if they need to. They can talk to anybody in transactions. We offer classes in the world, different days of the week, and we have self-help places you can go. And Texas agent handbook and everything is up on the wall for any kind of resources they might need. And yeah.
All right. Thank you very much, Sheila. And you're not AI, and you're a live person, right? Not AI, right?
Yes.
All right. Thank you.
Administrative support admin here.
All right. Thank you very much.
7 days.
Thank you. Have a good
9
one.
a.m. to 5 p.m.
Yeah. So we have 7 days now in Texas. Central time.
Oh.
So when a person comes in, or even myself, I can pull the ticket. So there's managing brokers here. So these are all hired staff. So the brokers are W-2. We're still 1099, but the brokers actually work for you. They work for me, which is great because we're all shareholders of the company because we're publicly traded. So actually all the agents, we're all shareholders now. So, in Texas, I believe there's 13 brokers now, and say half the agents leave, they scale down, right? Or if they start growing, they have to add more people. But that has nothing to do with me as a broker because of their support. So training, we have 80 hours of live training per week. So say if there's a live training going on right now in Texas, going over contract, just like what Judy and Cindy were doing, this can be all done. Oops. So if there was a live class, you would hop in here and listen to a speaker, just like today, live, going through that. Another thing, what we've learned is we can do hybrid. So if there's a great class that we all want to take with the team, we can actually watch it here, have a hybrid discussion afterwards, or we can ask them questions. So we've learned to actually leverage this because there's over 80 hours of live training. So as a broker, I don't have to do all the trainings every week. It's here. We can do it hybridly. So that saves time. Another thing is cost, right? If I'm starting to expand in different markets and, the there's one reception here in Texas, right? But imagine in Texas, there's 1,000 brokers. Every broker has an office. They all have a receptionist. That cost. They eliminated that cost. So 1,000 offices saves paying $6,000 rent times 12 months is $72 million. By going virtual, they eliminate that hard cost. We're a real estate company without the brick and mortar. That's why we're a disruptor. So the cost savings can be passed on to agents. That's why agents get stock. Agents get revenue share. They share the revenue. If you start growing the company, there's revenue and things like that. So a lot of that is detail stuff that if anyone's interested, just kind of understanding, I would love to go over. But what we've able to do is leverage to create a real estate community and support our partners in every different way. We have a lot of syndicators that have joined our group. So within the club, there's different resources. So the main thing when we talk about this is, hey, how can we add to the table so we can all share resources in this club? And that's what we're doing. So we're about 200 people within the past 3 years, and it just continues to grow. I'm working in Toronto, working on a group in Toronto. I pulled a couple Remax groups over, the brokers over. So the model works as long as you find the right people to work with you. So that's what we're about. And just glad to meet you guys if I haven't met you before. But the goal is just kind of sharing what we're doing. And, I was shared this platform 5 years ago. I kind of didn't look at it, but no one showed me the world. They just showed me, hey, you can do this. There's, stocks. So I didn't care about that. But when they explain, when I saw this, then I was like, okay, this makes sense because they're able to cut costs. And then every broker will try to figure out how to cut costs and scale, because imagine if you're independent and you have 100 people, it's a lot of management. You got to hire people. All that back end now with 200 people, I'm not hiring extra people. I'm actually able to, there's an economy of scale component to it. And I get to meet people all over the country now. So, and that's what I enjoy. So, all right. Lunch across the street. We'll go JS Chen. It's just right across the diagonal over there. We do have, we'll do a family style. We can have vegetarian as well, and dim sum and all that. If you guys want to come hang out with us, have lunch, and have a great conversation, network.
Yes.
All right. Thank you.
Did you all register in the class?
Oh, whoever needed 1 hour CE credit, there is a $10 charge. Cindy can handle that. And then that will go to donation for the charity that you guys are doing. Is that
No, it's assigned.
assigned to charity? Okay. All right. Thank you.
So if you want CE, then text me.